The recent gold rally has taken headlines driven by a broader shift structurally in global capital allocation. Welcome to the channel where we cover financial focused topics from broad macro to specific deep dive. I can't think of a better topic to kickstart our very first video but to cover on the recent gold rally. In today's video, let's look into the gold price rally, understanding what drove this rally, and my view on whether the rally will continue. Now, before I go into the video itself, please note that this is not investment advice, but purely educational. So please conduct your own due diligence before investing. So, where are we in the market? To put things into perspective, the price of gold is currently trading near 4.2k US dollar per ounce at the time of this recording. This represents a gain of approximately 60% since the beginning of the year. This performance has significantly outpaced major global equity indices. S&P 500, for instance, only grew 15% year to date, even outperforming Bitcoin, which only grew 16% year to date. The sustained momentum, particularly the aggressive buying following each brief pullback, suggests that investors are not merely trading short-term, but are positioning for a prolonged structural bull market. Now, the key question is, what are the driving force and why now? The reality is that gold has been rising gradually over the past months, but the intensity of growth is more prominent in the last few weeks. There are a few key drivers. Number one, geopolitical risks, or rather fear of global uncertainty. Gold is a politically neutral asset, unaffected by sanctions or bilateral dispute. In simpler terms, people and countries are rushing to gold because they are worried about the world suddenly changing for the worse. Wars, sanctions, trade fights. The Geopolitical Risk Index measures the occurrence of impactful events by counting the keywords used in the press. A high score has a strong impact on overall investor sentiment, which is evidently elevated in the last 3 to 4 years. As geopolitical instability persists across key global regions, institutional and sovereign wealth funds are rotating capital into gold that carry zero counterparty risk. This is a foundational fear trade. The second driver is the expectation of rate cuts. The market is not aggressively pricing in future US interest rate cuts. And since gold is a non-yielding asset, the expectations of declining real interest rate significantly lowers the opportunity cost of holding it, thus boosting its appeal in relation to fixed income alternatives. Furthermore, the persistent concerns over high US debt levels are contributing to long-term US dollar weakness. This provides a technical tailwind for dollar-denominated gold. The third driver, and perhaps one of the most significant structural change, central banks, particularly in emerging markets, are buying gold at an unprecedented pace to diversify reserve away from the US dollar. People's Bank of China, for instance, has been one of the most consistent buyers of gold for years. Central banks are not short-term traders, and as such, this sustained, non-price sensitive demand provides a powerful and permanent structural floor to the gold price. The fourth driver, and perhaps one of the biggest contributor to the gold price rally as well, is the flow of funds into gold exchange-traded funds. Gold ETFs are now a primary source of demand that directly influence the global gold price. Before gold ETFs launched, buying gold was mostly limited to physical bar, which involve high costs, storage, security issues, or futures contracts which are complex. Now, gold ETFs are widely available. Gold can be traded like any other financial assets. If you look at the chart itself, the flow of funds into gold ETF in 2025 itself has reached unprecedented level, which sort of explain why the gold price rally. Now, I'm going to talk a little bit more about gold mining stocks, which are also a major winner due to the price rally for gold. The surge in the commodity price has a positive impact on gold mining stock or gold-focused stocks. Major gold stocks have in many cases seen their equity prices outpacing the percentage gain of physical gold, confirming this strong correlation. Now, I won't go so much into the gold mining stock and its performance, but just to share on its strong correlation. Looking ahead, there will be pullback for sure, as we have seen this week, but the macro fundamentals suggest that gold price momentum is likely to continue. Our forward-looking view is based on 4 factors. Number 1, more new entrants, retail and institutional, will push price upwards. Number 2, robust central bank buying will continue. China is just an example, with many emerging markets accumulating, which will ensure that sovereign demand remains strong. Number 3, The eventual pivot by the Federal Reserve to cut rates remains the key monetary catalyst expected to push gold into a new phase of its bull cycle. And number 4, the ease of exposure to gold through ETF will drive record inflows into gold-backed exchange-traded funds. Given these factors, major institutions have significantly revised their forecasts. HSBC is one notable example, recently publishing a forecast that gold price could reach a high of 5,000 US dollars per ounce in the first half of 2026. These targets underscores the institutional view that the current rally is driven by a sustained multi-year structural shift and not just a short-term speculation. The gold bull market is well justified by geopolitical risk, monetary policy dynamics, and the unprecedented official sector buying. Whether you are invested in physical gold, an ETF, or gold equities, understanding these macro tailwinds is critical for navigating the next phase of these historic trends. If you found this analysis helpful, please ensure you hit the like button, and more importantly, subscribe to the channel for continuous data-driven market insights.